Before we dive in, just a quick disclaimer, I am not a financial advisor. This video is for informational and entertainment purposes only and is not financial advice. Always do your own research and never invest in anything based solely on what you see on the internet. Now let's get into it. So guys, about 6 years ago, something happened to me and I'm not even really sure where it came from, but I had this epiphany that told me I needed to start investing. Maybe it was because I was unhappy at my job. Maybe it was because I was 26 at the time and was starting to think more seriously about the future, or maybe it was a combination of the two, but somehow I stumbled upon that classic Warren Buffett quote, the one where he says, if you don't find a way to make money in your sleep, you will work until you die. Well, there was no way in heck I was going to do that. So in February 2020, just a few weeks before the world shut down, I opened an account with Robinhood and told myself I was going to start putting money away every single week. Even if it took me 30 years, I was going to invest my way out of that cruddy job. And even though I had no idea what I was doing, I was determined and extremely motivated to learn the ropes. I started off with about $1,800, and over the next few months, as I got my first real reps in with investing, my little starter portfolio grew into quite the motley crew of stocks. And by October that year, right around when I started posting on YouTube, I had a collection of 22 different holdings, most of which paid a dividend, with the exception of a few like Dropbox, Beyond Meat, and Virgin Galactic. I know, guys, it was a strange time for me. But anyway, in addition to this new Robinhood portfolio, I also had an old custodial account on Charles Schwab from when I was younger, which definitely was not dividend focused. But that was also a nice chunk of change that helped serve as a starting point in my new investing journey. And fun fact, that Charles Schwab portfolio is still the same one I invest in today, and it is now valued at almost $100,000. Now looking back, I'd say I was off to a pretty decent start because really I think any sort of investing is better than no investing, but still I was all over the place. And if I'm being honest, I had no idea why I was buying any of these stocks, but how could I? I was brand new to all of this stuff, just figuring it out with no plan. I was just taking it all in. I remember that at that time, one of the biggest things I struggled with was knowing what to look for in an investment and knowing what information actually mattered. I mean, these days, there's so much noise out there that it's even harder for brand new investors getting into it to figure all that out. And that's a big reason why I use tools like stocknews.ai, which is actually the sponsor of today's video. And I want to tell you a little bit more about it. So guys, the biggest problem for most investors isn't a lack of information. It's actually the opposite. It's too much of it. These days, we are incredibly fortunate to have access to all the data and information in the world right at our fingertips, but too much of a good thing can also be overwhelming. And the truth is, a lot of the news out there doesn't really matter in the grand scheme of things, and most people don't have hours every day to sift through all that noise just to figure out what's actually worth paying attention to, and that's exactly the problem that stocknews.ai solves. This is an AI-powered news platform built specifically to save you time. You just want the important information that's relevant to your portfolio, and this platform is designed to filter through all the noise and deliver exactly that. I've been using this tool for a little while now, and as you can see, I built a custom watch list inside the platform that tracks all the companies I'm following, both the ones in my portfolio and the ones on my watch list, and it automatically pulls in all the relevant updates. I get the earnings releases, any dividend announcements, other company happenings, really everything's right there in one place. And what I really like is that it doesn't just list the headlines. Using AI, it summarizes each article into short bullet points so I can get the key takeaways in seconds instead of reading through the full-length posts. On top of that, beyond just summarizing news, you can also launch tailored AI research prompts to help you learn more about the companies you're following. It's basically like having an AI research assistant right at your fingertips, which once again is a huge time saver. Honestly, I think this is one of those tools that every investor should have in their tool belt. It cuts through all the noise and helps you focus on what's really important. And more importantly, it's going to give you back hours that you'd otherwise be spending sifting through things that, if we're being honest, don't really matter much in the grand scheme of things. With that said, if you want to see how stocknews.ai can save you time, you can try out a demo for yourself using the link in the description of the video or in the pinned comment, or you can just scan this QR code right here and it'll show you exactly how the newsfeed works. This tool has been an incredibly positive addition to my arsenal, and I'm positive that it will be the same for you. So definitely check it out and let me know what you think. Anyway, guys, getting back to it, it wasn't until January 2021 that I decided to go all in on dividend investing. So pretty pretty much a full year after I first started. I talked all about that in this video here from early on in my YouTube journey, and I owe a lot of that decision to go all in to the YouTubers I looked up to at the time and still do today, frankly, many of whom are now good friends of mine, like my main man Russ over at Dapper Dividends or PPC Ian. Putting this video together today actually made me go back and rewatch that old video from a few years ago, and what's funny is that I still stand by everything I said back then. I still love dividend investing because, first and foremost, I'm still crazy for that cash flow, probably now even more than I was back then. I don't think there's any better feeling than getting a paycheck for doing absolutely nothing and seeing that income continue to grow every single year. I also love that dividend income adds an extra dimension to this whole investing thing. You're not just relying on share prices going up to generate a return. You're able to generate actual cash flow along the way, actual cash in hand. And that cash flow is a true and unmistakable reflection of the company's operational performance, unlike share prices, which can swing in either direction for reasons that have nothing to do with what's actually going on in the business. And because of that cash flow component, one of my favorite things about dividend investing is the fact that you don't have to sell your shares down the road when you're ready to start living off your investments. Now, don't get me wrong, I know there's more than one way to skin the cat. I say that all the time, but I've never understood why I'd want to spend decades building up this collection of assets only just to start selling them off. That's never made sense to me. Why would I want to do that? If you do it right, your wealth can continue compounding even as you pull income from your portfolio, and that wealth can then be passed on to future generations. I think that's really powerful, and I also think that a multi-generational mindset can positively impact your decision making today. There's no need to speculate with get-rich-quick investments when you're not in a hurry. There is no finish line or time limit if you're playing an infinite game. Now, with all of that said, if I could go back to when I first started that Robinhood portfolio back in February 2020, knowing what I know now, I would do things a little bit differently. The main thing is that instead of spreading myself super thin across almost 24 holdings, which once again, I didn't really have a good reason for buying any of those individual companies, but instead of doing that, I would have taken a much more simple and straightforward approach to investing, something that looks a little bit like this. Now, as we can see, guys, this portfolio only contains 5 holdings. 2 of them are ETFs, which make up the bulk of the portfolio. We have 35% in SCHD. Love that ETF. We have 35% in the S&P 500 VOO. And actually, this is the same combination of ETFs that I have today in my Roth IRA. I dollar cost average into these every single week. So these 2 make up 70% of the portfolio, and then the remaining 30% is split across 3 individual companies that I, feel pretty familiar with and understand pretty well. That's Visa making up 10%, Procter & Gamble making up 10%, and Vici Properties making up the remaining 10%. Now, I think that with 70% of the portfolio in these 2 ETFs, I would have had a well-diversified safety net that offers, some solid share price appreciation and pays a nice growing dividend. And then I could have used the 3 individual stocks here that I'm familiar with and understand as an opportunity to try my hand picking these individual stocks. I think that this type of portfolio would have really given me the best of both worlds and would have been much more easy to manage than the 22 holdings I first started out with. And not only that, I think it would have given me an opportunity to walk with this investing stuff before I tried to run, and I came out of the gate with a full sprint. Now, some people might disagree with this hybrid approach, and they might say that you should only invest in ETFs if you are, brand new to investing, just getting started. And I definitely don't disagree with that. I actually think that's pretty sensible advice if you're looking for the most hands-off approach to investing. But if you want to learn about individual companies, if that interests you like it does for me, then I don't think a hybrid approach like this would necessarily be a bad way to go. And if I would have just stuck with this type of portfolio from the get-go, I actually would have done pretty well. So looking at a back test of this portfolio going all the way back from the start of 2020 until today, starting here with $1,800, I would have ended up with about $42,600 if I'd invested $100 every single month into this portfolio. Now, comparing that to the S&P 500, we would have ended up with a bit more from the S&P. And actually, if we scroll down looking at the annualized returns, we can see that across this time period, our sample portfolio would have generated an average return of about 11.5% compared to the S&P 500's 15.4%. So there is quite a spread here. And even though an 11.5% return in its own right really isn't too bad, that's actually a pretty respectable return. Interestingly enough, I would have still generated a higher return with my actual portfolio that I've been investing in in these last few years, seeing as it had an annualized return of almost 15% in the same time period. So quite a bit higher than the sample portfolio we just looked at, which for the most part, I'm just going to chalk up to luck on my part. I mean, I've definitely come a long way and I've learned a lot as an investor over these last few years, but still, I think overall, the key is to keep it simple when you're just starting out. There's no need to dive headfirst into dozens of companies that you don't yet know how to research. As a brand new investor, what really moves the needle in your portfolio are actually going to be your contributions, and there's a very specific reason for that that has to do with the first major milestone in your portfolio, and I'm telling you more about that in this next video right over here. According to Charlie Munger, the compounding effect doesn't really take hold in your portfolio until you hit about $100,000. So in this video, we'll talk about why getting to that first 100K is the most difficult, why things start to snowball after that, and also what you can do to get to that six-figure mark faster. So click right over here to check that out, and I'll see you in the next one.